Hey, welcome back to Oz.Fx, and today we're going to be talking about risk to reward. I'm going to be telling you about risk to reward ratios, lot sizes, position size calculators, all things risk management. I changed my setup before we get into this video, so anytime I'm looking at the computer, my attention is going to be this way because my camera's over here. So let's just dive right into it. As you can see, we got risk to reward, and this is just the definition that I found off the internet, and I wanted to break it down for you a little bit. And this is just like the normal question: how is risk and reward calculated in Forex? The risk to reward ratio, sometimes known as the RR ratio, compares to the potential profit of a trade to its potential loss, how much you're making versus how much you can lose. This is a concept that you need to have figured out before you go into a trade. You never want to just go into a trade without a stop loss. Basically, whatever you want to risk per trade figured out. You don't just want to enter a trade just pressing buy with no parameters set beforehand. Grounds to blow your account. It is calculated by dividing the difference between the entry point of a trade and the stop loss order, the risk. So how much you're willing to risk for that trade, like how much money are you willing to lose before that trade ends? And there's orders that you can put in the market so that the market just executes your stop right when the price gets to that level, so that you don't have to mentally press, okay, I'm done, let me get out. You set those parameters beforehand. That way the human emotion is taken out of it. If price hits that level, you're out, you're done. You lost the amount of money that you decided that you were going to risk. That way you can't lose any more and just continue to blow your account. It is calculated by dividing the difference between the trade and the stop loss order, the risk, by the difference between the profit target and the entry point. Other words, the reward. So how much are you trying to make? And if you don't understand that, I drew this down here. This is what you typically would put onto a trade. This is your trade planner. This is, so let's just, let me just draw something here to make you understand a little bit, or to help you understand a little bit. Okay, so I just drew a couple little lines here just to help you visualize this a little bit more. This is what you would put on your trade, how you would set your parameters of your trade on TradingView. And if you want to figure out how to use that, it's just this little button over here. And you can actually open this, and you have long position and you have short position. Long position is for buys and short position is for shorts. You just press long, you press this, and you can move this stuff all around. Okay, but back to this. Say you were entering a trade and your stop loss was going to be 10 pips. That is represented by this gray area here that I have written down in here, 10 pips. As you can see, let me hover over it. It says 10 down there. I can't hover over it because it's going to take my mouse off, but if you can see down there, it does say 10. This is how far and how much you're willing to let the trade go against you. So in other words, if the market came in like this, hits your entry right here, you would be filled. You would be in the trade. Now, if it comes all the way down here, that means you lost the trade. But let's just say that didn't happen. Say it came in and it reacted and it went your way. As you can see here, I have the entry denoted right here. This is just the line right here that you would enter on that I've already talked about. And this entire blue area here is your profit. This is your target. As you can see right up here, it says 60. So 10 into 6 equals a 1 to 6 risk to reward. 60 divided by 10 equals 6. Now let's say you were going to risk 2%. For every 10 pips, you make 2%. That's on this specific example. So if you have a 1 to 6 RR, then that means you are actually making a 12% gain on that trade. So if this scenario works out here and you have a 1 to 6 set up and you're risking 2%, then you just made 12% on your account. And that's one of the things that makes risk management so powerful, because if you lost this trade, you're only losing 2%. So you could lose 5 of these trades and then win one of these if they were all 1 to 6s and still be up by 2%. So if I was going from here and I went up 10 pips right here, I would be up 2%. 10 more pips, I would be up 4%. 10 more pips, I would be up 6%, and then so on. But that's enough about how to calculate risk to reward on the charts. Let's actually hop over into the position size calculator. Some people in my group were asking me for this, so I wanted to include this in the video. I'm not going to be talking about lot sizes and what they actually mean and how to calculate them like on paper and stuff like that. That's for another video or for another time. Or if you really want to learn that type of thing, just look it up. There's plenty of videos about it. I don't do it that way, so I don't really feel that I'm the one to bring that to you, right? So let's just say you were trading Euro USD right? First, you would come here and you put in your account size, and let's just say it was a $10,000 account, and your risk ratio, how much you're risking per trade, let's just say it's 2%. Stop loss, you would have to figure out how many pips, right? You got 10 pips, and then trade size, you just let that go. You just let that go, and then down here it tells you your results. You would be risking $200 on a $10,000 account if you were risking 2%, which units, you don't really got to worry about that. And then this would mean 2 lots. So if you were risking a flat 2% and your account size was $10,000 and you wanted to risk $200 on Euro USD, you would put 2 lots. Let's run through another example. Let's say we want to do, let's just pick GJ because the pips are different, right? Now remember, you get all this from this trade planner right here. You get how many pips that you're using from this right here, and your take profit you don't really need. All you need is the amount of pips that you're risking for your stop loss. This is why your stop loss is so important. Your stop loss is your profit regulator. Here, let me show you this. If I pulled my stop loss down to 20 pips, that makes my ratio go down to a 3, a risk to reward down to a 1 to 3. That means you're only making 6% if you're risking 2%. If I pull this up, see, I can make it a 1 to 10 if I only risk 6 pips. That's a super tight stop loss. And if you have a small account size, your spread may not even allow you to do that. Or if you are trading on something like an FTMO account or just some kind of prop firm trading account, you can easily make these kinds of trades happen. Or if you just have the capital available. Back to the position size calculator. GJ, $10,000, or let's just do a $5,000 account. Okay, 5,000, 2% risk. Let's just say you were going to risk, let's just go with 14 pips. Okay, you calculate, you would be risking $100 units right there, and you would have 0.98 lots. There's no need to make it any more complicated than it is. Those are the steps right there for the position size calculator. Be on the lookout because I'm going to be making a video going over One Click Trade Pro to use on your MT4 to make entering trades even easier. All right, so that's all I got for today's video. I will catch you on the next one.